Hello guys, and welcome to this Practice to Pass December 2020 session. This is Ijaz Khan, and first of all, can you all confirm that I am audible to all of you? Okay, great. And I hope that you people can also see my screen. That's great. So you people, every one of you is aware that it's a 5 day session, and as the name suggests, it's a practice to pass. But I'll make sure that I do give you a brief introduction of whatever we will be starting, but my focus will be more on exam practice. But before I proceed, I would like you people to send me a message on WhatsApp so that I can add you to the WhatsApp group. And in the message, am I audible to everyone? Okay, so I'm just writing my WhatsApp number on the screens, and I want you people to send me your ACCA number on that WhatsApp number so that I can add you people to my WhatsApp group, which I've created specially for this P2P. So that's my number. I just need your name and ACCA registration number. Can you people see the WhatsApp number? Great, I've started getting messages. Yes, Farooq, because that's how I will know that you people should be added to my WhatsApp group. So I'm just starting now, and meanwhile, I'm getting all of your messages on my WhatsApp number. And after the end of the session, today's session, I will just add you all to my WhatsApp group for all the support, and will also share my Google Classroom link on the WhatsApp group where you can access all the material at your convenience. So as you all know, a planner has been shared with you. I'm starting with the very first syllabus area, that is working capital management. Working capital management. What is working capital management? Working capital management, basically, the working capital management has an ultimate objective of creating a balance between two things: profitability and liquidity. The objective of working capital management is to ensure that company is hitting its profitability targets and not putting the liquidity at stake. For example, let me first explain what is working capital, right? Then we'll talk about the management. Working capital is basically a capital required to run day-to-day business of the company. And what are or what is the asset? What are the assets that we need to run the business on day-to-day business? We need inventory. We need cash. We may have to invest some part of our capital in as receivables, and sometimes it may be prepayments. So basically, it's the sum of all current assets, right? It's the sum of all current assets. So let's say we have a business and we estimated that we need inventory of say $20,000 or let's say $30,000, and we need cash of say $20,000, and we expect that our receivables will be $10,000. So a total of $60,000 will be required on a day-to-day basis to run the business. That's your total current assets. And of the $60,000, we may get some part of our inventory on credit through account payables, let's say. And let's assume that we can get a credit of $20,000. So we need a total of $60,000 to run the business on day-to-day business. But on the other hand, we are getting a credit of $20,000. So the net current assets that we need to run the business will be $40,000, and that's something that we need to invest from our own side. And this is basically called working capital. So a business has to think about this working capital and has to decide from where to bring this capital. So the first step for the working capital management is to find out how much working capital is required to run the business. The decision to keep a certain level of inventory is a working capital decision. The decision to keep a certain level of cash in hand throughout the year is again a working capital decision. How much credit period should be allowed? It's a working capital decision. Now, if we are managing our working capital, one of the things that we need to do is to ensure that we do not keep significantly higher level of inventory than we need. Because if we keep unnecessary level of inventory, it means we will have capital tied up in inventory, and we will be bearing finance cost on that amount of capital. On the other side, we have to ensure that we have sufficient level of inventory so that we don't face stock out situation. So the dilemma is, if we keep more stock, we will have more finance cost and it will reduce our profitability. On the other hand, if we keep low level of inventory, we may have to face a risk of stock out. So the best working capital management will be to ensure that we have sufficient level of inventory, and at the same time we need to ensure that we don't have unnecessary inventory so that we don't put our profits at stake. So a balance has to be maintained between both liquidity position and profitability position. That's what a working capital management is all about. Same goes for cash. If you have more cash in hand, you will be very safe, because if we have more cash in our hands, we will be in the best position to pay off our debts on time. But at the same time, if we have more cash and we need less, the additional cash that we are holding could be invested somewhere else, and we may earn profit on investing that surplus cash, but we may not be investing and we may be holding that cash with us and hence losing profitability. So more cash balance will lead to less profitability, better liquidity. On the other side, if we have less cash in our hands and we invest the surplus cash in our long-term investments, we may be able to earn more profits, but we may put ourselves in liquidity crisis. Neither of the situations will benefit us. Holding unnecessary cash balance, again, it's a curse for a business, and holding less than required cash in our hands will also be dangerous for a business. Therefore, a good working capital management will be to decide an appropriate level of cash balance so that the company neither misses any profitable opportunity nor it faces the problem of liquidity. In the same way, we do not have to be so generous when giving credit so that our capital is stuck up into receivables. On the other hand, we should not be so rigid while giving the credit period to our customers, because this will kick us out of the competition. So we have to ensure that we have a reasonable receivable strategy, and that's all about working capital management. So in a nutshell, a good working capital management will be that keeps a balance between profitability and liquidity. And in this section of the syllabus, this is what we have to learn: how to manage working capital. Now, so far I have discussed one aspect of the working capital, and that is the investing aspect of the working capital, in which we decide how much to invest in working capital, how much to keep in inventory, how much to hold cash, how much cash we should have, and how much to invest in receivables. There's another aspect of working capital management. If we have a requirement of $60,000 that we have to invest, the second step will be to find out the source of finance for these investments. We have to invest this $60,000 amount from any source. That source may be a short-term source, or it may be a long-term source. A short-term source may be account payable, that is getting credit, inventory on credit. It may be overdraft, it may be a short-term loan, or it may be a long-term source. We may raise equity finance, or we may go for a long-term loan. So there are multiple sources of financing working capital. So remember one thing, that working capital management has two broader aspects. One is the decision side of working capital, and the other is the financing side of working capital. And most of the students, they get confused in these two types of aspects. So remember, in the investment side, we decide how much to invest in working capital, how much cash we should keep, how much inventory we should have, how much to invest in receivables. Whereas in the financing side, we decide from which source this capital should be arranged, short term or long term. Well, Asha says that, hello sir, do you mean financing working capital or financing current assets? Financing current assets is basically financing working capital, because we need current assets to run our business on a day-to-day basis. There are two types of assets that we need to run a business. The long-term, the non-current assets, which we don't need on a daily basis, right? We have to purchase the building once, not every day. On the other hand, we need current assets to run our business, and that fluctuates on daily basis. We may have to purchase inventory after every 2, 3, or 5 days, or after every week. The receivable balance will fluctuate. The cash balance is going to fluctuate. So these assets fluctuate on daily basis, and that's why we call the investment in these assets are is called working capital. So I've shared this handout with all of you. An email has been sent to you from ACCA, and you can also download these resources from Google Classroom, and I'll share the link of Google Classroom with all of you once I create a WhatsApp group and I add all of you to that WhatsApp group. Okay, so now let's first discuss one more concept, that's working capital cycle. Working capital cycle or cash operating cycle, these are the two terms that are interchangeably used often. And what is working capital cycle? Working capital cycle is basically the time period between the day when we pay for our purchases and the day when we receive the cash back from our customers. Say, for example, we purchased goods on 1st of January on credit, right? And on 5th of January, we made payment against these purchases. So our cash operating cycle will start from 5th January. That is the day when we make payment against the purchases. Now the time of working capital cycle will start from this day, and it will end on the day when we will receive our cash from our customers. Let's say on 10th of January, we finish the goods. On 15th of January, we sold the goods on credit, and on 20th of January, we collected the cash against the goods that we sold on 15th January. Now, who's going to tell me what will be the cash operating cycle? How many days are in this cash operating cycle? Remember, we made payment on 5th of January, and we received our payment on 20th of January. So it's around 15 days. It's around 15 days, right? That's what the cash operating cycle is. So if you have to calculate cash operating cycle, what is going to be the formula of calculating the cash operating cycle? So I'll just write it on the screen. If you need to calculate working capital cycle, all you have to do is first of all, we need account receivable days. That is, how much time do our customers take to pay us back? That's account receivable days. So I'm just, for the sake of simplicity, assuming few figures, right? So let's say the account receivable days is, let's say, are 25 days. So it means that our customers usually take 25 days to pay us back. Then we should add inventory days. That is how much time the inventory takes to get sold. Let's say it's 15 days. So it takes 15 days for the inventory to get sold. So it means that we keep inventory in our stock for 15 days. Then we should add these two, and from this we should subtract the credit period that our suppliers allow us, and let me assume that it's 10 days. So from the day of purchase till the day we receive the cash, right? Let's say it's 40 days, and we are being given a credit period of 10 days, which will reduce our working capital cycle to 30 days. That's called working capital cycle. So we have to add these 2 days and subtract the account payable days, not the account payable, it's account payable days, to find out the working capital cycle. Now, my question to all of you is, if you have a business, what type of working capital cycle you would like to have? A short one or a lengthier one? I'm waiting for all of your response. Okay, great. Okay, so most of you have said shorter one, and that's correct answer. That's a correct answer. But I have got few more answers that which says that would say that it depends. It depends. Well, it depends on nothing. If I am a manager or if I am managing working capital, I will always want this operating cycle to be as low as possible, as short as possible. Because the lengthier the cash operating cycle or the working capital cycle, the more finance cost I have to bear. So why would I want to bear more finance cost? Right? Now, few of the students, they have said that it depends. I haven't talked about what the actual cash operating cycle will be. The actual cash operating cycle will definitely depend on different circumstances. I just asked what should our preference be as a working capital manager. If we are the manager, we will always want it to be as short as possible. Definitely, we will have limitations. We cannot reduce it below a certain level, but we would like to have it as short as possible because of the finance cost involved. No business in the world would like its cash to be stuck up. Every business wants to recover its cash as early as possible so they don't have any liquidity problems, so that they can invest the surplus cash and earn more, right? So it should be as low number as possible. Now, quickly, my question to all of you: if you see a business which has a longer working capital cycle, how are you people going to reduce the working capital cycle? How can you reduce the working capital cycle? Quick. Wow, excellent, excellent, excellent. All of you are coming up with the right answers. One of the ways through which you can reduce is to have an effective receivable management, right? You should have account receivable management, effective account receivable management. And you should have a good and effective receivable management, inventory management. You should have a good cash management. You should have, you may offer early settlement discounts so that your customers pay early, right? You can use just in time inventory system. all are all of these are the ways through which you can reduce your cash operating cycle. And we are going to solve questions related to account receivable management and inventory management. But most of you have come up with the right answers. So the same type of a question may be asked in the exams by asking you how we should be reducing the cash operating cycle. So I hope that it's clear now how to calculate working capital cycle. And we will be solving questions on that. The first part of my lecture is just a quick recap of the concepts which you people may have already gone through. So a quick yes from all of you if it's clear now. Thank you so much. I'm very happy to see that I've got a bunch of students who are very interactive and very respondent. Okay. So now let's discuss the length of cash operating cycle. That is the factors on which the length of cash operating cycle depends. First of all, it's the liquidity versus profitability. That is, if a business, what type of a business may have a lengthier cash operating cycle? No, Heather, there is no difference between inventory days or inventory turnover days. They both are same as far as they are reported in days. Only inventory turnover differs when it is in times. And I'll come to this. I will just explain inventory turnover and inventory days. Right? So a business that wants to be more liquid will have a lengthier cash operating cycle. And this type of business will usually have more cash in hand, more inventory, and more amount of capital stuck up in receivable because they want to be liquid. But they compromise on profitability. On the other hand, a business that wants to have more profits, it will have a lower level of investment in working capital, and it will invest the surplus capital in long-term investments rather than tying up its capital in short-term investments, the current assets. So a company that wants to be more liquid will have a lengthier cash operating cycle. A business that wants to be profitable will have a shorter working capital cycle. Number two, management efficiency, a very obvious factor. If your management is efficient in receivable management, it will be able to receive its cash quickly from its customers, and hence it will be able to reduce its cash operating cycle. If your management is very efficient and operates just in time inventory system and orders inventory whenever is required without the risk of stockouts, again your cash operating cycle will be shorter. But if the management is inefficient, it will hold more inventory, it will have more cash in hand, and hence will have a longer cash operating cycle. And third, industry requirement. A manufacturing business will have to keep raw material inventory, it has to keep finished good inventory, it has to keep working process inventory. So it will usually take more time for a manufacturing business to recover its cash as compared to a trading business, which will have just one type of inventory, and that is finished goods inventory. So again, yes, a few of you just mentioned that it depends on a manufacturing business and a trading business. A manufacturing business will have a lengthier cash operating cycle usually as compared to a trading business. Now there is another small concept, and it is called over trading. So anyone having any idea of what over trading is? If you can just explain what is over trading. Again, I'm very much impressed from all of you. Yep, exactly. The over trading is basically where a business is trying to do too much with too little long-term investment. For example, it is increasing its trading volume significantly, but you all know when you want your business to grow, you need to invest. You need to expand your business by investing in machinery. Maybe you need to expand the building. You have to invest in working capital. You have to invest in other fixed assets. You may need to raise debt finance, long-term debt finance. You may need to raise equity finance to support the growth. But when a business is trying to grow, trying to expand its trading volume without expanding its fixed assets or without investing in fixed assets, that is called over trading. So with this definition, my question to all of you is it good for a business to be over trading or not? Yeah, very good. No business, it's not good for any business to be over trading. It's never good for a business. It backfires. It backfires because if you are trying to make too much sales with too little production capacity, your orders will be delayed. Your customers will be annoyed because they will be receiving the orders late. It will affect your goodwill. You have to rely too much on overdraft. You will have to pay your debts that will be uh, uh, that you have to pay in a short period of time, and you may not be getting your cash back from your customers, and you will be in a serious liquidity crisis, and it may lead to bankruptcy. So no business can afford to be over trading, right? So don't you think we must know whether a business is over trading or not? Yep. We need to know whether a business is over trading or not, because unless and until we know, we cannot manage it. So how are we going to know that a business is over trading? There are symptoms which tell us whether a business is over trading or not. Now, one of the symptoms will be a rapid increase in turnover. When you see a significant increase in a company's sales, that is one of the symptoms. But remember that this is not to be taken in isolation. There is no harm for a business to grow its sales significantly. The only harm is when this growth is not backed up by long-term investment. So a rapid increase in turnover, number one. Number two, if your current ratios and quick ratios are decreasing, that is a sign of over trading. When you compare the growth of sales with the growth of long-term investment, and you find the growth in long-term investment as significantly lower than the growth in sales. Say, for example, I'm just quoting an example. Let's say we checked a growth of a company and we found that the sales have grown by, say, 50%. And when we checked the long-term investment, there was only 2 to 3% increase in its long-term investments, in its capital employed. Then this is a symptom of over trading, because to support a 50% increase in sales, we don't think that a 2% or 3% increase will usually be sufficient in the fixed assets. You will have more reliance on short-term source of finance, either in the form of trade payables or it may be in the form of overdraft. So when you see the balance sheet of a company to have overdraft and increase in the trade payables, these are another symptoms of overtrading. Current ratio and quick ratio will fall as I discussed earlier. Receivable days will be increasing. The payable days will be increasing. Inventory days will be increasing. And the sales to working capital ratio will also be increasing, showing that we are increasing our sales significantly without backing it up by working capital. No, it's not, because when you have to increase your inventory, you and you don't have capital of your own, what source are you left with to buy the inventory? You will either have to ask the bank to give you overdraft facility to buy the inventory, or you will ask your suppliers to give you inventory on credit, and that in return will increase your account payable, because you don't have investment of your own, so you have to rely on short-term investment. So if majority of these ratios are present in any company situation, then we can say that the company is over trading. Now, what a typical type of a question will look like in over trading? A typical question will be that you will be given with the balance sheet and income statement of a company for 2 years. You have to calculate different ratios like percentage increase in sales growth, current ratio, quick ratio, sales divided by working capital ratio for both years, gross profit margin, net profit margin, sales to capital employed ratio, which we call as asset turnover ratio. So I'm just writing all these ratios on your screens, and you people can take a screenshot of this so that you know what type of ratios you need to calculate. Current slash quick ratios, sales divided by capital employed, and it is called asset turnover ratio. Gross profit slash net profit margin, inventory slash receivable slash payable days, sales to working capital ratio. Yes, Hamza, whatever I write on the screen will automatically be saved on the Google Classroom. I will give you people access to my Google Classroom where you can find all the work that we will be doing in these 5 days. So current and quick ratios, sales to capital employed ratio, gross profit and net profit margin ratios, inventory days, receivable days, payable days, sales to working capital ratio, and sales growth. That should be in percentage form. No, you don't need to calculate overdraft ratio. Just simply, if you see an increase in overdraft, that should be stated. So no need to calculate a ratio. Just you need to see whether the overdraft is there or not, or if what it was there in both years, whether it has increased or decreased. What is your question, Samula? So a quick question from all of you. What should be the symptom in case of current and quick ratio? Increase or decrease? Excuse me. Excellent. It should be decreased. Okay. What about the sales to capital employed ratio? The sales to capital employed ratio. Yes, it should be increasing, because the increase in sales to capital employed ratio shows that you have increased your sales significantly without increasing your capital employed, right? So there will be a significant increase. Okay, what about the gross profit margin and net profit margin? It's decreased, right? Very good. And there is a reason why it will be decreasing, because you want to increase your sales, you may be offering discounts, and in return it will reduce your gross profit margin and net profit margin. What about inventory days, receivable days, and payable days? Increase. Sales to working capital ratio? Increase. Sales growth? Significant increase, right, in sales. So you have to calculate all these ratios first, and if you see majority of these ratios in the direction reflecting overdraft or over trading, then what should be the discussion? How you should be writing or discussing it? Now that's more important to know. Shayan, the way you have asked this question, how to contact sir for questions, I can see your question. So whatever you are, whatever question you are asking, you can ask me here. Emmeline, that's what the measures are. I just mentioned all these measures. You need to calculate all of these and look for these directions. It means if these ratios are behaving in this way, it means it's over trading. No, overdraft should not be included while calculating trade payable days. Overdraft should be treated separately. It should be discussed separately. Afri, your question is why is increase in sales to working capital a sign of overtrading? Because if this ratio is increasing, it means that we are increasing our sales without significant increase in our working capital investment. The profits will decrease because of giving discounts to customers so that we make more and more sales. And Nadeem is asking, how are we going to find out the increase and decrease? Do we have to compare it with the market? No, in an over trading question, we usually don't compare it with the market. It is always compared with the last year. But I'm not saying that it won't be compared, right? It can be compared with the market as well, but most of the times it will be compared with the last year. Abdullah, yes, If the overtrading is successful, it will lead to more profits, but the risk of failure will be higher. Okay, now how do we discuss this, right? Just hold your questions for a while. I'll allow you people to ask me questions. Once I'm done with one part of the topic, I will definitely ask you people to ask me questions. I will allow you people to ask me questions. So if you can just hold on your questions for a while and let me complete so that it's not distracted. So how are we going to discuss it, right? So I'm just letting you know how to discuss a question on working capital, over trading. Now, all these calculations should be done in the working section of the question. And when you are discussing all these, the right way of discussing it will be to start with an introductory paragraph about telling what is overtrading, like a brief definition of what is overtrading. Secondly, telling whether overtrading is good for a business or not. And thirdly, explaining these symptoms. So how you can start explaining these symptoms? Let's say I'm just giving you an example, right? So you can start discussing in this way. One of the symptoms of over trading is the decrease in current ratio. In case of this company, the current ratio is decreasing. Therefore, we can say it is one of the symptoms of overtrading that is present in this company's case. In this way, you will be discussing every symptom. And once you have discussed all the symptoms, you have to conclude in the end by stating whether the company is overtrading and not. So if you see most of the symptoms going in the direction of overtrading, then you can end up by concluding that since majority of the symptoms or all of the symptoms are present in this company's case, therefore the company is over trading. So we have a question that was there in the past exams called Gorva company. So I'm just giving you some time to calculate all the ratios in this company's case. And once you are done with calculating all the ratios, then we will discuss whether this company is over trading or not. You can find these files in your handout section. And also let me give you my Google Classroom link as well, so that you can join the classroom as well. So you can join the Google Classroom through the link I have provided. No, that's not a WhatsApp group, Sarah. For WhatsApp, just look at the chat box. You can see my WhatsApp number. I will also show you my WhatsApp number. Just text me with your name and ACCA number so that I can add you to my WhatsApp group. So that's the number on your screens. So giving you people 10 minutes to calculate all these ratios, and then we will discuss whether the Gorva company is overtrading or not. So we will be back in 10 minutes time. Okay. Okay. Meanwhile, I add you people to my Google Classroom. This question could be found on Google as well. Just search for Gorva company, Gorva company financial management. You will get this question. Don't worry, I am going to add all of you who have texted me on WhatsApp, I will add all of you to my WhatsApp group. But since I've got more than 200 messages at the moment, so it will take some time for all of you to get added to the WhatsApp group. Have you people started the question? Great. So anyone who hasn't started the question yet, just start the question, the Gorva company question. You can find it in the handouts, or you can also search Gorva company financial management on Google as well. So I hope you people have done the question. So let's try it. Okay, let's do some workings. Two 2007, 2006. First of all, let's calculate sales growth. So sales growth will be calculated for only for 2007 because it will already be a comparison between 2006 and 2007, right? So sales growth. So I'll show you an easy formula to calculate the sales growth. Just pick the recent year sales 37,400, and from this subtract, sorry, divided by the previous year sales 26720, and then subtract 1 and select the percentage symbol. So it's 39.97% sales growth in 2007 compared with 2006. So it seems to be a very significant sales growth, right? Approximately 40%. Yep, it's approximately 40%. Now after sales growth we can have gross profit margin, and that should be for both years. So the gross profit, okay, they have given us one type of profit, right? The operating profit. So we can say it's operating profit margin. I subtracted 1 because if I divide the complete sales figure of 2007 by 2006, it will give me an index value, right? Because it is taking 2006 as a base year. So I have to subtract this one time, which represents the 2006 sales. So it will give me the additional sales figure in percentage form. Abdullah, is it clear? Okay, gross profit margin will be 2992 and divided by 37400, right? And again it should be in the form of percentage. And for 2006 the operating profit was 23781 divided by the sales figure of 26720. I've done some mistake. 2939 divided by 26720, and that's 11%. So you can see now we can easily see two of the symptoms. The sales have grown tremendously. The gross profit margin, or you call operating profit margin, has decreased by 3 percentage points. Okay, what are the other ratios that we need to calculate? Okay, let's calculate current ratio, right? Current ratio will be the current assets. The current assets are 9200 divided by the current liability, which is 7975. So it should be in times And for the 2006, it is 4600 divided by 3600. So it's 1.277. Another symptom. It was 1.27 times in 2006, which has decreased to 1.15 times in 2007. Another symptom of overtrading. Quick ratio. Quick ratio will be current assets minus inventory. And since there are only two types of current assets, so it will be a waste of time if I pick 9,200 and then subtract 4,600. Why not I directly pick trade receivable figure and I do not pick the inventory figure? So I can just simply write 4,600 instead of picking up the total current assets and then subtracting the inventory figure. So 4,600 divided by 7,975 is 0.57. It's already too low in 2007. And here we have 2,200 divided by 3,600. It's 0.61 times. So there is a reduction in the current quick ratio as well. So another symptom of overtrading. Let's move forward and calculate account receivable days. Now, may I know what's the formula for account receivable days? Anyone? Do you people know what's the formula of account receivable days? Anyone? What's the formula of calculating account receivable days? Average sales divided by cost of sale. No way. Okay. So it's average receivables. It's average receivables divided by credit sales into 365. So average receivable figure for 2006 is 4,600 divided by the sales figure of 2007, which is 37400 into 365. So it's 45 days approximately. So anyone who was coming up with a different formula should correct himself or herself. The formula is the average receivables divided by credit sales into 365 and not cost of sale. Okay, for 2007, the average receivable figure is 2,200 and the sales figure is 26720 into 365. 30 days. So the receivable days have increased from 30 to 45 days approximately. Then we have inventory days. Inventory days will be the inventory balance, which is 4,600 for 2007, divided by the cost of sales figure, which is 34408 into 365, And for 2006, the inventory figure is 2400 divided by 23781 into 365. So again, increase in the receivable days. So slowly and gradually we are reaching to a conclusion that the company is over trading. So the payable days will be calculated by picking up the trade payables, and 4750 here are trade payables. 4750 divided by purchase figure. Usually we take the credit purchase figure, but in this case, since we don't have purchase figure, we can take cost of goods sold figure as our credit purchase figure. But remember, as long as possible for the payable days, we should always pick credit purchases. So the cost of sale figure is 34408 into 365. And for 2006, the payable figures are 2000 divided by 23781 into 365. So again, an increase in the payable days as well, right? So Ahmed, I'm coming back to your question. Ahmed has asked us a question that how do we calculate the average receivable balance? Here we do not need to calculate the average receivable balance, but usually if we are required to calculate the average receivable balance, we pick up the opening receivable balance, we add the closing receivable balance and divide it by 2. So overdraft increase. Now the overdraft increase will be calculated in a form of percentage like 3225 divided by the previous year overdraft, and from this we need to subtract 1 because this gives us with the base figure, so 1 need to be subtracted and convert it into a percentage. So there has been an increase of 101% in overdraft. You can say it has almost doubled, more than doubled from previous year. Another indicator. Now since we have already got majority of the indicators there, therefore even if we say that it's over trading, it will be enough. But there is one important factor, left, that is sales to capital employed, right? So let's calculate that one as well, which we call asset turnover. Right? So let's just calculate asset turnover as well. So the asset turnover will be calculated by dividing sales by 37400 divided by capital employed, and capital employed is calculated as total assets minus current liabilities. So what are the total assets? Total assets. Okay, they haven't given us total assets. They have rather given us the net current assets and non-current assets, right? So we can simply add these two to calculate the capital employed figure. So The non-current assets are 13632, 13632, and we can add net current assets that are 1225, and this is the capital employed figure, in fact 14857. But let's calculate 1225. So if you want to calculate capital employed, one of the formulas through which you can calculate the capital employed is non-current assets plus net current assets, or you can call working capital. So in the numerator we have capital employed, and in the numerator we have sales. In the denominator we have capital employed, and that's asset turnover, which is 2.5 times. What does this show? This shows that using $1 of investment we have generated $2.5 of sales in 2007. For 2006 we have to pick the non-current assets. We have to pick the sales figure of 2006, which is 26720. 26720 divided by the non-current assets 12750 plus the net current assets. The net current assets are 1000. So you can see that the sales to capital employed ratio has increased from 1.94 times to 2.52 times. Now let me quickly explain what does this mean. In 2006 we generated $1.94 of sales through $1 of investment, but through the same $1 of investment in 2007 we have generated $2.52 of sales. So we have increased sales more than we have increased the investment, which shows another sign of over trading. So let me repeat one thing. Most of the students, they have asked for how I have calculated the overdraft. Just quickly, if you people can look at how have I calculated the overdraft percentage increase. It's a very simple way to calculate an increase from one year to another year, and that is, let me calculate it in a different way, and then I'll show you the shortcut of calculating it, right? So I want everybody to listen, to watch carefully. The figure of overdraft in 2007 is 3225, right? So it's 3225, and this figure was $1,600 in last year. So what was the total increase? It was $1,625 increase in the overdraft, right? Now what was the overdraft figure in 2006? It was 1,600, and there has been an increase of 1,625 in this figure. So if you want to check the percentage increase, all we have to do is to pick this 1,625 increase and divide it by the previous year's overdraft figure to find out the percentage increase, and it is 101.56%, which is exactly the same as this one, right? So this is another way of calculating this increase, but I'll show you the shortcut. Again, all you have to do is, if you want to calculate increase in two figures in the form of percentage, you should pick up the latest figure, that is 3225, the latest one, and divide it by the previous figure 1,600, and close the brackets, and now you will get a ratio of current year compared with the previous year. Now from this figure just subtract 1, you will get the same answer of 101.56%. but remember to multiply it by 100 to convert it into percentage. Rida, the decrease will be calculated in the same way. If the answer is in minus, it means that there was a decrease in it. So now what we can do is, since all of the symptoms are present in the over Gorva company's case, we can simply say that the company is over trading. So I think you people need a break. In fact, you people deserve a break. Let's take a 15 minutes break and come back after 15 minutes. So, welcome back. I guess we are done with the break. So, I hope everybody is back. Okay. So, let's discuss the theoretical portion further. The overcapitalized is exactly the other way around. When you have more capital available, more investment in fixed assets, but you are not able to use and generate sales accordingly. So you have too much. You have invested too much, but you're not able to capitalize. You're not able to take benefit of that investment in the form of sales. So that's called over capitalized. Is there a reason why we didn't complete sales to working capital ratio? No, there is no specific reason because all of the ratios and all of the measures, all of the factors are already there to suggest us that the company is over trading. So one of the ratios won't make that difference. Yes, undercapitalization or over trading, they are both same. Okay, so a quick discussion on investing strategies. Investing strategies. There is an aggressive strategy and there is a conservative strategy. In the aggressive strategy, remember whenever you hear this word aggressive, the tilt will be always towards profitability. The tilt will always be towards you call it policy or you call it strategy. The tilt will be towards profitability. So, and profitability. Now just tell me, when will be the business more profitable? If it invests more in working capital or less? Invest more in working capital? No, they invest less in working capital and they invest more in the long-term investments. Because if they invest more in working capital, that would mean they will be holding more cash. So holding more cash will mean less profitability. So less investment in working capital. Remember. On the other side, The conservative strategy is focusing more on liquidity. They don't want to take risk. They want to be liquid so that they can pay their liabilities on time. So they don't want to be they don't want to take much risk. So hence there will be no profitability. So they will be investing more in working capital. Investing more in working capital, more inventories will be kept, more cash will be held, and more generous credit policies will be offered. So that's conservative for you. So investing strategies, there are two types of investing strategies. Now when it comes to financing strategy, there are three types of strategies: aggressive, matching, and conservative. Now this is where most of the students make mistake. In the financing side, we have got three types of strategies, whereas in the investing, we have only two. Now, what is meant by these three? Now, as I told you, that the aggressive means more profitable, conservative means less profitable, but less riskier as well. So there are two types of working capital requirements for any business: the permanent working capital and the fluctuating working capital. Right? The permanent working capital is basically the minimum working capital requirement for a business. For example, every business will have to keep a minimum level of inventory, a minimum level of cash, and maybe a minimum level of investment in working capital. So the level of working capital that stays throughout the year is called permanent working capital. But in seasonal businesses, from time to time, the working capital requirement increases and then comes back to its minimum. The part of working capital that fluctuates during the year is called fluctuating working capital. Now, this is something that the business needs throughout the year. And this is the one that a business needs from time to time, not throughout the year. In the aggressive strategy, remember, in the aggressive strategy, they finance their fluctuating working capital through short term, as fluctuating working capital is not permanently required. So they borrow money on short term basis to finance their fluctuating working capital. And this does make sense. If you don't need this investment throughout the year, what's the point of taking a long-term loan for this requirement? So they invest through short-term, that is overdraft, payables, or short-term loan. Right? Now, remember one thing: short-term loan is always less expensive. Whereas long-term loan is more expensive. That is, the interest rate on short term is always lower than the long term, but short term is more risk bearing. It has high risk, it has a low risk, because this will be paid in short period of time, and you will have a very short time to pay off this debt, and that may not be sufficient time at times. Whereas you have a lengthier period to pay off this long-term debt. That's why the risk level is low. So fluctuating working capital is financed through short term under the aggressive strategy, whereas some part of this is financed through short term. This is where the aggression is. You know that the permanent working capital is required throughout the year, but still, if it is financed, some part of it is financed through short term, that is called aggressive strategy. They are taking a risk. They know that the requirement is permanent, but still they are financing part of this working capital through a short term source. And the reason is they don't want to commit to a fixed cost, a higher fixed cost. They want to lower down their finance cost so that the profitability is increased. And it may not make sense. That's why it is called aggressive. Well, if it's extremely aggressive, Afri, then they may go for complete part of permanent working capital through short term. But most of the times that may not be the case, because it will be too risky to have the complete permanent working capital part financed through short term. But even if they finance some part of the permanent working capital through short term, that's even riskier. So you can still call it aggressive strategy. Any example, sir, of any short term finance used as long term? I did not get your question. Can you just explain your question? Okay, the conservative one. In the conservative one, they will finance the permanent working capital through a long-term source, and even some part of the fluctuating working capital will be through long-term. They want to be safe. Yeah, they may take a short-term bank loan to finance their permanent working capital, expecting that in, let's say, they know they need $20,000 working capital throughout the year, and they may take a $10,000 short-term loan for the 20,000 permanent working capital, and that short-term loan may be due in 3 months' time. So they may be expecting that after 3 months they will get their cash back from their customers, and they will pay the bank in 3 months' time, and then take this loan back or reschedule this loan again for another 3 months, and this will go on throughout the year. So they will be taking the short-term loan, paying the long-term loan, short-term loan in 3 months' time, and then taking it back. So this is what they expect, but it may not be the case in practice. They may put themselves in trouble after 3 months. Yes, running finance can be used as short-term. Yeah. And in the matching one, the permanent will be financed through long-term, whereas the fluctuating will be financed through short-term. That's called the matching strategy, because you need this working capital permanently, so it should be financed through long-term. You need this working capital at times of the year, so you should finance it through short-term, and that's why it is called matching, because you are needing you are matching the need with your source. I hope these three strategies are very clear. Fluctuating working capital is the level of working capital that fluctuates throughout the year. That is, you may need this fluctuating working capital in one part of the year, and you may not need it in the other part of the year. Like in peak season, you may need additional inventory, additional cash. But in the off-peak season, you may not need to hold more inventory, more cash, but there must be a minimum level of inventory. There must be a minimum level of cash that you need throughout the year. You can't imagine any business to keep zero level of cash in any part of the year. So there must be some level of cash in hand. throughout the year, and that is called permanent working capital. No, Sudhir, non-current assets are never considered to be part of working capital. Working capital is the current assets, but a part of the current asset that you need throughout the year is called permanent working capital, and the part of current assets that you may need from time to time is called fluctuating working capital. Right? I've got another question on the WhatsApp, and the question is, can you just explain the matching again? Well, it's a very simple. You know that working capital is required, permanent working capital is required throughout the year. So you should invest through long-term source. Let me define it with figures. Let's say a business needs 30,000 of working capital throughout the year, but from time to time it may need additional $20,000. So the total requirement will be 50,000, right? So the matching will be to get these $30,000 through a long-term source. That is, you may get a long-term loan of $30,000 to finance these $30,000, or you may raise equity finance to finance these 30,000. But for the fluctuating one that you need from time to time, which is $20,000 in this case, you may take short-term loan to finance this. Say, for example, just for 2 months, you may need this for just 2 months. Why should you be taking a long-term loan for this? So you may go for a short-term loan from the bank, or you may take an overdraft facility for 2 months to finance these $20,000, and that's called matching strategy. I hope that's clear now. So a quick yes from all of you so that I move forward. Okay. And just a quick feedback from all of you. If you can just rate from 1 to 5, how is this session going so far? Five is excellent and 1 is poor. Thank you so much, and I will try my level best to increase that 3 or 2.5 to 5 for other students as well. And since I have a time constraint, so I will request every student who has rated 2.5 or 3.5 or 3 to just stay in touch with me on the WhatsApp group so that I can help you out with your queries. Right? So let's move forward. Now, let me quickly explain few of the ratios. Let me explain few of the ratios with concepts so that you don't go for rote learning and you understand the concepts of calculating ratios, right? So let's say now I just want you people to concentrate because you all know how do we calculate account receivable days, right? So with the help of formula. So in the next 5 minutes, I will try to explain the rationale behind calculating account receivable days with a particular formula. So I just need your concentration for a while. Let's say, I'm just assuming, let's say you make sales of $1,000 daily, right? Every day. And just a quick question and just respond to the question. If the company gives a 1 day credit, right? Credit period of 1 day only one day, right? So at the end of day one, what will be the receivable balance of the company? $1,000, right? At the end of the day, it will be $1,000, right? Excellent, excellent. So it will be $1,000. Now my question is, what should be the account receivable balance at the end of year day two? What will be the account receivable balance on day two, at the end of day two? Everyone, forget about the interest. I'm not talking about interest at the moment. What is going to be the, okay, so just imagine I have on day one I made a sale of $1,000, right? And I gave a 1 day credit period, which means that at the end of the day this amount will be a receivable balance. The next day I'll make another $1,000 of sales, and that will also be for 1 day credit, but the next day I'll receive the previous day's sales, right? So these $1,000 will be received. These $1,000 will be received, and there will be no more receivable. But at the end of the day, these $1,000 will be again receivable. So the receivable balance at the end of year at the end of day two will again be $1,000, because we would have received this one. Okay, that's the second day. Sorry, that's the second day receivable balance, right? So what will be the receivable balance at the end of day three? If we sales $1,000 again on day three, that's the daily sales, right? Every day we make a sales of $1,000. So remember, every day we are making a sale of $1,000, and since we are giving credit of 1 day, credit period of 1 day, the receivable balance is $1,000. It is equal to 1 day sales, and the reason is because we are giving a credit period of 1 day. Now let me change this example. Let's say we are giving a 2 days credit period. What will be the receivable balance at the end of each day? Everyone, what will be the receivable balance at the end of every day if we are making $1,000 sales every day and we offer 2 days credit period? At the end of the first day, the receivable balance will be 1,000. On the second day, it will be again it will be 2,000. On the third day, we will receive these 1,000, but these $1,000 and these $1,000 will be outstanding, so it will be $2,000, and thereafter it will stay at $2,000 if every day we are making a sale of 1,000, right? So the receivable balance will stay at $2,000 now throughout the year if the credit period stays to be 2 days. Now the receivable balance is equal to 2 days of sales. It's equal to 2 days of sales, and the reason is because your credit period is of 2 days. It means your receivable balance will always be equal to your credit period sales. If your credit period is 2 days, your receivable balance will be equal to 2 days worth of sales. If each day you make a sale of 1,000, your receivable balance will be equal to 2 multiplied by 1,000. So again, my question to all of you, what will be the average receivable balance throughout the year if we offer a credit period of 10 days? Excellent. Excellent. It will be equal to 10 days of sales, right? 10 days of sales. Okay. Can I write this formula? Is this correct? Account receivable will be equal to credit period multiplied by daily sales. Is this correct? Yes or no? Right? Okay. Can I write it in this way? Account receivable is equal to credit period into annual sales divided by 365. Can I write it this way? Okay. So it means that we can use this formula for calculating account receivable balance, right? So just note this formula down. This will be needed in the working capital management later on as well. So just write down this formula for calculating the account receivable. We need credit period and we will multiply it with the annual sales figure divided by 365 to find out the account receivable balance. Now, can we reverse this formula for calculating credit period? Can we reverse this formula for calculating credit period? So what will be the formula for calculating the credit period? The credit period will be equal to account receivable divided by annual sales multiplied by 365. Is this correct? So here we go. We have derived a formula for calculating the credit period. We can calculate account receivable days with the help of this formula. That's how this formula has been derived. Now, if we are going to calculate account payable days, we can just change the variables. The account receivable will be changed to account payable. The annual sales figure will be changed to credit purchases or cost of sale and then multiplied by 365. And in this way, we can calculate account payable days. And if we need to calculate inventory days, the account payable will now be changed to inventory divided by cost of goods sold into 365. The same principle applies here. So these are the three different formulas for calculating different values for receivable days, account payable days, and inventory days. So the same formulas can be used for reverse calculation if we need to calculate receivable, account payable, or inventory. So I hope everybody has got this derivation from 1 to 5. Quick. Okay, so this handout contains all the formulas that we need to use in working capital. Yes, cost of goods sold and cost of sale, they both are same. So let's now start with inventory management. So I'm just giving you 5 minutes quick, and just quickly solve this question on your screens. If you don't have this handout at the moment, just take a screenshot of this question, and then I'll show the requirement as well, and we'll give you 5 minutes to try this question yourself, and then I'll be solving it for you. Aisha, I am going to share everything that I discuss here on the Google Classroom. Let me once create the WhatsApp group, and then I'll add all of you to the WhatsApp group and share the link to join the Google Classroom. And by the way, the Google Classroom link has already been shared on the chat box, and it will be shared with you in a while as well. So you people can join the Google Classroom as well. So everything will be shared in the Google Classroom. So first, just take the screenshot of the question. I hope you people have taken the screenshot, right? I'm just displaying the requirement now. Okay, let's solve the question now. And the first part is about calculating the annual cost of the current ordering policy. So let's calculate the current cost of ordering policy. So part A, the question is, TNG company expects annual demand for product X to be 255380. That's the annual demand. Product X has a selling price of 19. So let's calculate the purchase cost first for the whole year, right? So purchase cost will be equal to annual demand 255380. That's what we need to order throughout the year, right? And the price, this is the selling price, right? The purchase cost is $11. So we are not supposed to calculate the revenue. We are supposed to calculate the cost, which is 11 per unit, the purchase price. So let's multiply it by 11. So the annual purchase cost will be 2 million, 2.8 million, right? So that's the annual purchase cost. So after annual purchase cost, there's annual ordering cost. Now, how many units are we ordering in the year? That is the annual demand, which is 255380, right? And we need to divide it by the order size to find out the total number of orders that we are placing in the year. So TNG places an order of 50,000 units at regular intervals throughout the year. So every order is of 50,000 units. So let's divide it by 50,000 to see what is the number of orders. It's approximately 5. So approximately 5 orders are being placed. Okay. And what's the cost of each order being placed? Where is the cost per order? The cost of placing an order is $25. So let's multiply it by 25, and it's 128. Then comes the holding cost of the year. For holding cost, we need to find out the average stock first. Now, average stock, we don't know what is the average stock, but we can calculate the average stock, and we can also calculate buffer stock. But let me write the average stock formula for you first. Average stock is equal to safety stock, which we also call buffer stock, plus order size, whatever the order size is, and divide the order size by 2. So order size should be divided by 2, and then safety stock should be added to this to get the average stock. So now what we need is safety stock first. So usually the safety stock will either be 0 or it will be given. But in this special case, they say that the safety stock should be of 28, should be equal to demand for 28 days. Now we know the annual demand, right? 255380 is the annual demand. So then we have to convert it into per day demand, and the working year is of 365 days. So the per day demand will be divided by 365, right? So if we divide this 255380 by 365, we will get the per day demand, and if we multiply it by 28, it will give us the safety stock. Okay, let me repeat it. Let me repeat it. To calculate the holding cost, we need average stock. The formula for average stock is the buffer stock, which we call safety stock. And in this, we need to add the order size divided by 2. That's something that you have already studied in your management accounting course. So this is the formula that you should remember. The order size divided by 2 plus safety stock if any. According to the question, the safety stock is to be maintained as demand for 28 days. So we have to calculate a demand for 28 days, and that will be equal to our safety stock. So the annual demand is 255380, and if we divide it by 365, it will give us the daily demand. By multiplying this daily demand with 28, we will find out the demand for 28 days, which will be equal to your safety stock. So this is safety stock. Now let's put this value into the average stock formula to calculate the average stock. So average stock will be equal to safety stock plus order size. The order size currently is 50,000, and let's divide it by 2 because it's part of the formula. So divide 50,000 by 2 and add the safety stock to get the average stock, which is 44,591 units. That's our average stock. Now, in order to calculate holding cost, the formula for calculating holding cost is average stock multiplied by per unit holding cost. The per unit holding cost is, this one is the per unit holding cost, and the storage cost for product X is 10 cents per unit per year. So to hold 1 unit, it costs 10 cents, which means $0.1. So this is the average stock throughout the year, and each unit is going to cost 0.1. So what will be the total holding cost? The total holding cost will be $0.1 into the average stock, 4459. And now let's add these three costs: purchase cost, ordering cost, and holding cost, in order to get the total cost of current ordering policy. Is that clear now? Collie, you said it's too fast. Now, is it okay now? Okay, great. Farheen, yes, annual demand divided by EOQ or order size, whatever you're using, is the formula for calculating number of orders. So that's the current ordering cost. So that's the current inventory cost. So we are done with part 1. What is the part 2 of the question? In the part 2, calculate the annual saving if the EOQ model is used to determine an optimal ordering policy. Now we need to the total cost. We have already done with the total cost, so there is nothing else left in the total after the total cost. James, what do you want me to repeat? The holding cost. Okay, holding cost is equal to the average stock, which is 44,591, multiplied with the 10 cents, that is $0.1. Mohammed, is it clear now? James, the total cost is just the sum of these three costs: the purchase cost, the ordering cost, and the holding cost. If we add these three, it's the total inventory cost. Okay, for part B, it says what will be the saving in the cost if we switch to EOQ model. Yes, all the formulas are in the handouts. Okay, for the B part, we need to go through 2 steps. First of all, we need to find out EOQ, economic order quantity. Right? So the formula of economic order quantity is, just look at the formula. The formula of economic order quantity is 2 multiplied by cost per order multiplied by annual demand 255380, and this should be whole divided by the holding cost per unit, which is $0.1, and then we should take square root of all this. Now we have a formula in Excel to get the square root, but I will make it more easy for you. Just take power 1 divided by 2. You know that square means power 1 upon 2. So I'm just taking power 1 upon 2, that is square root of whatever is in these brackets, the highlighted brackets. So just let me repeat. 2 into cost per order into annual demand divided by holding cost. Once you get this, just take power 1 upon 2 to get the EOQ. And I've got the error. Don't know what's wrong. Okay, let me check it one by one. Okay, there's the error. Still getting the error. Okay, I've just put the multiply sign. I'm sorry. I don't need to put the multiply sign. It's the static. 2 into 2 into 255380. Excel is very sensitive. Into cost per order 25. I should use the right symbols, right, for Excel. Divided by 0.1, and I should put brackets around this, and then I should take power 1 upon 2. It's 11,300 units. So if we order 11,300 each time we place the order, that will be our EOQ. Instead of ordering 50,000 at a time, now we should use 11,300 as our order size, and we will go through all this again, right? So I'm just copying this whole thing and just pasting it here, so it saves my time. Okay, and now let me change only the order size. The annual demand will stay as 253380 and the purchase price will be 11, no change, so no need to change. The ordering cost, in the ordering cost section, the annual demand will remain the same, but this time I'm not ordering 50,000, I'm ordering 11,000. So instead of using 50,000, I should refer to 11,300, and the cost per order will be 25. So the revised ordering cost will be 565, and the formula for holding cost M22, that is the average stock, which will be recalculated, right? So we have to calculate the average stock again. So let me calculate the average stock again. Average stock will be equal to safety stock plus reorder level, which is 11,300 this time, divided by 2. So safety stock plus EOQ divided by 2, that's the average stock, and multiply it by 0.1 to get the total annual holding cost, and it should be 565. So what mistake did I make again? Safety stock plus EOQ divided by 2, that's the average stock, and it should be multiplied by 0.1. Okay, because of the safety stock the figure will not be the same. Okay, so holding cost 2524. So now our revised costs will be the sum of 281269, and the savings will be 281367. minus 2812. That's the saving. If we switch to EOQ, the cost will be reduced by $1498. Yes, you can copy anything within the same question. You can't copy something from one workplace to another workspace. Yes, holding costs. Okay, let me explain holding costs again. So for holding costs, what we need is we need average stock, right? So average stock will be equal to safety stock, which was 19591, plus EOQ divided by 2. EOQ divided by 2. So if we divide EOQ by 2 and add the safety stock, it will give us average stock, which is 25241. Now, if we need holding cost, we need to multiply average stock by 0.1, that is the holding cost per unit per annum. That's it. Rida, Sarah, did you people get it? Okay, there is a question by Adnan. Sir, why ordering cost and holding cost are not same in the EOQ? Usually it is same just because of the safety stock. It's not the same just because of the safety stock. If the safety stock figure is assumed to be 0, then holding cost and ordering cost will always be the same. Let's say if I remove, let's say, let me show it. Let me show. If I remove the safety stock figure from here and I just take EOQ divided by 2, look at this. Both figures are now same. Adnan, is it clear? Both figures are now same. I just removed the buffer stock figure from my average stock. But since the question has buffer stock, so I can't ignore it. So I should include buffer stock in my calculation. Well, you don't have to mention the formula, but definitely you have to apply the formula like I did here. If I don't do this and I just directly write the figure, the answer, how is the examiner going to know what have I applied? So formula has to be applied. That's the only way the examiner is going to know how you have reached to a particular figure. So do not skip any formula. Do not do one mistake in the exams. Most of the students, they may make this mistake by solving a question on the calculator and then putting a figure directly into the spreadsheet. Don't do this mistake. If you are calculating something, it must be calculated on the spreadsheet. Do not use calculator while using spreadsheet. So why are we using buffer stock? Because the buffer stock was in the question. That's why we have used. Otherwise, we can simply ignore the buffer stock. But we have to ignore in both parts. No, you can't simply write the formula and then directly write the answer. Then what's the point of using spreadsheet? Just imagine for a while why ACCA has given you the spreadsheet. You have to use the features of the spreadsheet. Yes, Abdullah, one of the assumptions of the EOQ is that there should be no safety stock, right? But you're yourself saying it's an assumption. So you can assume that there is no safety stock, then you have to skip the safety stock for both part A and part B. But since the question has asked you to calculate indirectly though, to calculate the buffer stock, as they have said that the buffer stock is kept for 28 days. So there must be a reason why they have given you this information. So better to calculate safety stock in this case. Okay, now let's do the third part, right? So if there is anything that you want to repeat, this video will be shared on Vimeo Pakistan page and you can watch it again. So I'm just left with 15 minutes, so I have to complete this question because we have to end inventory days today. The inventory part should be ended today. So let's solve this C part of the question where it says determine whether the discount offer by supplier is financially acceptable. Now, what is the discount and what is the condition of getting the discount? The supplier, okay, that discount is not for the inventory, it's for the early settlement discount. So we're not covering the receivable part today. So okay, supplier's discount. Where is the supplier's discount? I can't see it in the question. I think some part of the question is missing. So I'll just search for the other part. I don't know, maybe it's missed while taking the screenshot of the question, but I'll just add it later on. No, the early settlement discount is for the receivable management, so that's another part of the question. Okay, we have a supply. Okay, I'm just sorry. TNG normally pays trade suppliers after 60 days, but MKR has offered a discount of 1% for cash settlement. No, I thought it's a cash discount. Cash settlement within 20 days, and TNG company has a short-term cost of debt of 8% and uses working year consisting of 365 days. That's a receivable discount. That's not a discount, the trade discount, the bulk purchase discount. It's not a bulk purchase discount, it's a receivable discount. So we are not covering the receivable part at the moment. We will come back to this part once we are discussing the receivable management. Right? So let's discuss the third part, the D part of the question. Discuss the advantages and disadvantages of using just-in-time inventory management system. Do you know what is just-in-time? A quick answer. What is just-in-time? Yes, just-in-time means you only order inventory when it is required. So you don't keep inventory unless it is required. That's called just-in-time. So what do you think will be the advantages if company just orders inventory when it is required? Quickly, the advantages. Yes, number one, you don't have to bear finance cost, which is part of holding cost. No cost of obsolescence, no cost of wear and tear, no cost of warehouse. So it will reduce your inventory costs, holding costs, right? One of the benefits. What is the second benefit? The second benefit. The second benefit is increased efficiency. It increases the efficiency. And how is that so? If you have high level of inventory, it will hide inefficiency of purchase department. the purchase department can easily hide their inefficiency behind stock, behind inventory levels. It may be their inefficiency because of which you have to keep more stock. So if you hold no stock, it will always put the purchase department on their toes, and they will always be ready for purchasing the for placing the order on time. The third benefit is improved relationship with suppliers, because when you have JIT operating, it means you need to have good relations with suppliers so that you receive your order on time whenever it is required. So the pressure that you don't have inventory will push you to maintain good relations with your suppliers. So there are three major benefits of having just-in-time system. Number one, reduced inventory costs. Number two, improves the efficiency of purchase department and all other departments, not purchase department. It also improves the efficiency of your production departments as well. Third, it improves your relationship with your suppliers. Now, what are the drawbacks of just-in-time? What are the drawbacks? Yes, Abdullah, very right. It increases your ordering cost because you have to place orders frequently, number one. Number two, it will increase your risk of stockouts. It will increase your risk of stockout, which is a very dangerous thing for any business. And because of stockout, you may have delay in your production process and it will lead to increase in idle time costs. It will result in damage of goodwill if the customer orders are being delayed just because of the stockout. And it will also reduce your chances of optimizing the limiting factor. So these are the drawbacks of having just-in-time inventory system. For 7 marks, I think we have already discussed enough. So if you have 6 points, 3 of the advantages and 3 disadvantages, it will be enough for 7 marks. Right? So I'm giving you home assignment for today. Just go through this day 1 worksheet, these different sheets. Go through these different sheets. We are already done with Gorva company. We are done with the TNG company. So the second sheet and the last sheet, FLG. So go through the second Ulnat company and the last one, FLG company. Just go through this and we will discuss these two tomorrow. So for a quick feedback, how was today's session from 1 to 5? Yes, Rakib, I can see your messages. Thank you everyone for the wonderful feedback. Shayan, I'll try my level best that we cover maximum of the syllabus areas. Since this was the first day and it happens every time, but I will end up completing the syllabus. I have my plan. Don't worry. Sumit, never do this mistake. Never do this mistake. Ashar, I have uploaded my course notes on Google Classroom. You can use those for theoretical part. Yes, what I'll do is I will just create a WhatsApp group, and on the WhatsApp group I'll just try to share a video of how to access Google Classroom and how to use the resources. Rida, I don't think that will be possible. There is no link of WhatsApp group. I will add you people individually on the WhatsApp group. Yes, Ashar, I will also explain how to solve CRQs in the on the last day. Aksa, which messages are you talking about? Sending on here on the GoToWebinar platform or WhatsApp? Aksa, I can see your messages on the GoToWebinar, but I haven't checked it on WhatsApp yet. Yes, Koli, the assignment is to solve this ULNAT company question and this FLG company question. Thank you, Aksa. I hope everybody in the session has learned today. Yes, the session is over from my side. I'm just taking questions from all of you. So nothing new I'm going to discuss. Actually, that's something for you to look from ACCA. I think ACCA representatives will be in the best position to talk about this. But as far as my opinion is concerned, I think the center-based exams will be conducted. As far as I'm concerned, that's my personal opinion. Well, this worksheet will be available on the Google Classroom, so you can download it from there. So I'm just sharing my WhatsApp number again with all of you. Just send me WhatsApp send me a message on WhatsApp. I'll add you on the WhatsApp group, and we can continue with these queries on the WhatsApp group as well, because we are approaching towards the end of the session today. So that's my WhatsApp number. Just drop me a message. I'll add you to the group, and we can continue with the questions on the WhatsApp. So thank you guys. Talk to you soon tomorrow. Have a good day. Sure, Ifra. Just send me the message. I'll add everyone. Okay, bye.